Good evening and welcome to Money Matters. My name is Jim Bultler with Videre Wealth Management, and my co-host tonight is Dave Witt of Witt Capital Management.
Jim, good to see you again.
Good to see you, David.
Here in the dog days of summer.
Dog days of summer. Although we don't like to date ourselves from the time we chat when the show is aired, but as I like to say to outsiders and clients, it's never a dull moment in our business.
Oh, there's never a dull moment.
What sort of hot topics do you find at the top of the list with your clients these days?
Well, you know what? I mean, we've been looking at some long-term trends and in the market, and this recovery, starting in '08 after the crash, has been sort of anemic. You know, it hasn't been really all that exciting a recovery. It's. I'm a little concerned about employment numbers. I don't think they're real. I think that there's a lot of people that were looking for work just gave up, so they're not included in the unemployment numbers. And I guess it's probably 7 or 8 years into this. What's the average bull market last? 6 years, 5 years? What is it?
I think it's no more than 60 months.
That's 5 years.
Yeah,
and we're past that.
We're past that. We're 6 years. We're 7 years. By the time this show airs, we're beyond 7 years, and who knows where the market's going to be at that time.
As we're speaking, the market could be down, so we don't know.
Yeah. Well, one of the things that I find interesting is that as we talk with clients, there's an expectation and a hope that the markets will continue to grow despite the challenges such as the employment numbers that you mentioned and the growth of the economy, because of course we would all like to see our investments continue to grow consistently.
Yeah.
But we know that's not going to happen. So we have conversations periodically with our clients to point out that because we're 7 years into a bull market, it's above average, that at some point there is going to be a pullback.
Are you moving into cash at all?
I'm not actively moving into cash at this time, but if there's an overweight in cash, I'm not afraid of that, and I point that out to clients. Mm-hmm. And if there's an overweight on the fixed income side, say short maturities, I'm not afraid of that either, because what that provides is a degree of liquidity and an opportunity to invest when market prices pull back.
A lot of people invested in oil-related service stocks, and in 2014, late in the year, couldn't really believe the magnitude of the drop in the price of oil back then, when OPEC didn't, cut production. And cash would have felt real good, very good, when you're watching, your stocks getting pummeled. So cash is good when the market pulls back. You just can't tell when. Well,
that's the thing. I mean, when it comes to timing the market, we suggest to our clients not to try and time the market. But if you look at long-term charts of the S&P 500, and I'll define long-term as 5 years or longer.
Oh, okay.
30 years, sure. 50 years, okay. But if we can apply a 5-year rule, meaning 5 years or less, that's short term. If you have need for money in that time period, then you have a separate investment strategy than, say, your 5+ year money.
Yeah.
Over 5 years, where's the market going to be relative to where it is today? And if you look at the trend line of the S&P 500 over the past 5 years, 10 years, 15 years, 20 years, there's clearly blips along the way, but the trend line is up. Mm. And with interest rates low for the foreseeable future, I think
there's a reason why interest rates are so low.
Yes.
And I have subscribed to the demographic theory that generally the populations in the industrial world are aging, and there's not as many youth coming along because the baby boomers are the chief cohort. And so as the baby boomers are trying to get out of their mortgage and they're not buying new cars and they're not spending a lot of money, instead of a need for money, there's a need to go to more cash and own your investments, and there's no demand for money from the private sector. So that's why we have these zero interest rates and negative rates overseas. So I don't see any prospect of any major rise in rates anytime soon.
It's an interesting conversation.
It is. So people are looking for some kind of yield, and and people that have lived on CDs and money market funds there is no return.
No, you're right. But that actually leads us to the question that came in from one of our viewers, being yield conscious. And Mary Kelly from Ardmore, Dave, is asking, what pipeline companies give the best dividends?
That's Mary Kelly from Ardmore. That's a great question. The pipeline companies vary in what they pay out. I mean, Shell Midstream probably yields 1.8%, but they'll raise their distribution by 35% per year. And there are other MLPs, pipeline companies, that might yield 8% or 9%, but they have no prospect of really raising their distribution. So a good yield, to me, in the MLP space, because there's two characteristics. One is the yield you're getting. You also expect that distribution to go up pretty much every year, somewhere between 6 and 8%, maybe 5 to 7, somewhere in that range. So I would say it's a two-part answer. You want to pick an MLP that has a reasonably decent yield. That could be a Kinder Morgan at 4.5%, or Energy Transfer Partners at 7%, Tesoro Logistics at 4.8%. All those have the ability to raise their distribution, some more than others. So it's a combination. So you want a good yield, but you also want to have that yield be well covered, strong balance sheet, strong operating cash flows, and that's how you find them.
How would an investor be able to identify strong companies that are likely to grow their dividends?
They would talk to somebody who specializes in MLPs and who does the research and looks into it. A research company that would look into the basins where they're operating from, what oil basins or what natural gas, and what the prospects are for continued growth in those areas, whether they're diversified or not, whether their ability to raise a distribution is there, a number of factors. I think it might be possibly difficult for an individual to be able to decipher one that's strong versus one that's weak, because two could be yielding 7% and one will be yielding, whose distribution will go up 5 or 6% per year, and the other will stay at 7%.
Right.
Then the market's going to find out which is good and which is bad, and the one that didn't raise the distribution is going to be penalized. You could lose money on that one,
right,
whereas the one that's raising distribution will make money.
So pay attention before you
Pay
invest.
attention to all these metrics.
Right. Good.
Homework. It's going to be a lot of homework.
Yeah. Thank you, David.
Sure.
And thank you, Mary, for your question. And feel free to send in a question to us. We'd love to hear from you. And the screen will fill you in with how to do that.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our hosts and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
Welcome back. We have a very special guest to visit with tonight, Stephen Schork of the Schork Report. Welcome, Stephen.
Stephen, welcome.
Thank you.
Good to see you.
Good to see you.
So you are an expert in the energy field,
Yes.
and you have spent many years there. So what can you tell our viewers about your specific area of expertise within energy?
Well, certainly. Right after university, I entered the energy market as a trader and analyst during the first Gulf War, so in 1991. So it was a very exciting time to get into the market. But then through the rest of the 1990s, we were looking at oil prices that averaged $17 a barrel. So it was a very staid market for the next 10 years. And then, of course, everything began to explode about 10, 12 years ago. So what we do now is provide a daily research note on the energy markets, specifically, or I should say mainly crude oil and the natural gas markets, and how this pertains to not only the producer, the guy pulling the hydrocarbon out of the ground, to the person transferring it, to the person who's burning it, and everyone who's trading on it. So we in the market provide the daily analysis. Myself, am also a trader. Used to be a trader down the floor of the New York Mercantile Exchange. I still do take positions in the market because I do this, because I sell research. I have to know how good my research is. And if I'm making money, well, the research, I'm onto something. If I'm losing money, well, I'm missing something out there. So that said, we provide a service because we do have a dog in the fight, and our clients do appreciate that.
Are most of your clients on the institutional side, Steve?
Yes, we're talking the people who read the note are the majors, OPEC, a lot of the heavy industrials, and a lot of, well, it used to be the Wall Street banks, but the banks have been pulling out of the commodity markets over the past past year, and we're getting more back into the hedge funds. So probably the investor or the trading class would characterize about a third of our business, and then the other 2/3 would be split between the producer, anyone who's actually involved in the energy itself, to a hedger who's actually has to burn the diesel fuel or so forth.
What is your mission with the Schork report?
Essentially to cut through the noise. We've been in the market now for the past 10 years, and that was right after the implosion of Enron. And what we saw was a fundamental shift in the market. Now, when I came into the commodity markets in the late 1980s, commodities in New York City were Wall Street's B team. And so I joined the B team, and we always took kind of a backseat to what was going on in the New York Stock Exchange. But because the fundamentals were shifting globally 15 years ago, and remember, when you have oil at $17 a barrel for 10 years, no one's looking for it. Then all of a sudden, 10 years ago, we had demand hit the market, but we didn't have enough supply. So you saw a whole shift of money come in, and all of a sudden, the NYMEX, the New York Mercantile Exchange, where oil's traded, now they're the A team and relegated the stock exchange to the junior varsity. So you had a tremendous amount of money coming into the market. So what you had was the market divorced itself from the economic realities of supply and demand to deliver you the equilibrium price. And you had so much speculative investor money come in, it really changed the dynamics. So for our letter, that we do speak to both the guys, I say burning it and pulling out of the ground, and help them wrap their head around other drivers determining price.
So the period of time from like up until the end of 2014,
Yeah.
oil's trading around $100 a barrel.
Mm-hmm.
Why?
Essentially, you had still a tremendous amount of demand in the market. So there seems to be this argument, and I do not buy into it, that this is a supply-driven sell-off that we saw beginning in the summer of 2014. Now, I don't buy into that from the standpoint that supply has been increasing month in, month out for the past 4 years. All of a sudden now, towards the end of the third quarter, and then, of course, at the OPEC meeting over Thanksgiving last year, you had this immediate plunge. Now, people assume that this has to do with supply. No, the supply is the supply. It is the demand that's the issue right now. If we look at the factory order numbers, the industrial production numbers, I'll venture to say the United States manufacturing, or the smokestack economy, is already in recession. Now, we've had a significant sell-off in oil. Not only in oil, but in lumber, but in copper, and in aluminum, the four most important industrial commodities. When is the last time good economic news created such a sell-off in these industrial commodities? The next time will be the first time. So this, to me, is two parts. It's demand-driven, or lack thereof demand-driven, and also we have to keep in mind that Saudi Arabia has used oil, has weaponized oil. We're seeing a fundamental split between the Sunni side and the Shia side within OPEC. The balance of power is starting to tilt away from the Sunni-dominated Arabs and the Israelis to the Persians, age-old enemies, Persia and Arabs, to a Persian nuclear-capable Iran. And Saudi Arabia certainly does not want to see that happening, hence why they refused to cut production back in Thanksgiving, and why I believe they will continue to cut, because they are initiating an economic war for oil, not against the producer in North America, because they can't compete with the producer in North America. But what they can do is certainly compete and try to keep Iran bottled up, because that country is so dependent on the revenues generated by their oil sales.
Well, that's a pretty broad view of the whole picture. And
So it sounds like we not only have domestic economic issues that come into play, but would you say that the global Mideast oversight is has much more of an impact?
It certainly has, and what we're looking at from a global standpoint, we have a number of drivers here. First and foremost, you keep in mind that there's an inverse relationship between the dollar and what we're seeing now with commodity prices. So it's not a coincidence that the dollar over the past year has rallied to an 11-year high, and we've had this pullback in oil prices. So now we have to ask, why are we seeing this? So you've got a situation now where if you look where Iran and Saudi Arabia are competing for their market share. It's not only, Saudis have North America because we can't import Iranian oil, but the main battle is happening over in Asia. And right now, the Chinese economy is growing at the slowest pace in 6 years. Japan is in the 4th recession of the last 7 years. Industrial production in India is falling. The situation with Greece and Europe is an absolute mess. So the bottom line here is, here, the U.S. economy, I don't believe it's all rainbows and unicorns. The economy here is certainly troubled. It's just as the old saying goes, we happen to be the cleanest dirty shirt in the laundry, and hence why we're getting this massive rally in the dollar, and what that potentially means not only for keeping oil prices depressed, but also now it's the demand factors that we all have to concern ourselves with.
You made a comment a few moments ago about a slowdown in domestic commodities. Were you actually leading up to the potential for a recession coming down the road?
Well, as I said, certainly when we look at the industrial production numbers, I think we're already in recession. So now we have to keep in mind there is this absolute myth out there that the price decline at the gasoline pump is some sort of tax savings. And it's completely backwards thinking, because what you have is, it's not, okay, I'm saving $1 at the pump. Okay, I've got $1 to spend elsewhere, but that's not an extra $1. So it just seems to be that this notion that, oh, just because I'm not spending it at this vendor, but I'm spending on that vendor, somehow that's good for the economy. It's nothing but a zero-sum game. Right. And if we look at from December, January, and February, the retail sales numbers were the lowest 3-month stretch since the collapse of Lehman Brothers. So even though we had this decline in gasoline prices, we didn't see an impact in retail sales. Consumers aren't spending. We're not seeing the impact in industrial production or in factory orders or personal consumption expenditures. So even though we think we're getting this savings, all we're doing is shifting the deck chairs around on a Titanic. We're not creating wealth out there. And commodity prices don't drive economies. Economies drive commodity prices, and hence you get this pullback that it's certainly sending a poor signal to the market. I think oil, the decline in oil and all of the industrial commodities, is the canary in the coal mine at this point.
So what trends do you see generally in energy over a 5 to 10 year period?
Well, earlier this year we had, of course, Shell buying BG. And so what you're seeing here is kind of what we started to see when Exxon acquired XTO a few years ago, that big oil is making the shift to becoming big gas. Yeah. So this is essentially, here in North America, we have an absolute an abundance of it. Some geologists will tell you that we have 200 years worth of supply. I'll be happy if we have 20 years worth of supply, because what these forecasts always tend to be is, okay, I'm going to steer all my eggs into the natural gas market, and what am I doing at the same time? I'm killing coal, I am killing the nuclear industry, I am depressing the oil industry, and now as a generator, today I have the option. I could either burn coal, I could burn nuke, I could burn a number of different hydrocarbons to create my electricity. But when we start to take that optionality out of the market and we only put in the natural gas market, something is going to happen. I don't know if that happens in a year, 2 years, or 5 years, but at some point when we don't have those options in the market, you're going to see a significant rally in natural gas, because that is where the trend is going, industry worldwide.
So going long natural gas for the long haul makes sense.
If you could buy 2018, which there is a market for on the NYMEX, 2018 for the year 2018 call options for $3.50, $4 a decatherm. That's probably a very low risk, high probability trade that you're going to do well on.
So let's bring
like
this let's bring this back to what I think many of our viewers would understand, which is how about the next 1 to 3 years? Is there any way an investor, Stephen, can invest in the energy market and make money?
Sure. Well, you guys have been talking about the MLPs, and this is giving us a fantastic opportunity because we're looking at a situation now where the oil producer in North America is not yet realizing when oil prices plunged below $50, the oil producer was still receiving $70, $80, $90 a barrel because they hedged forward. And what has happened, we had such a complete sell-off in oil in such a short amount of time. What this did was provide the producer the opportunity, because they were looking at $20, $30, $40 barrel profits in their hedge books. Right. They were able to monetize that, use that income to go ahead and load up on puts, which is what we've seen in the open interest in puts, which are puts are an option for bet the oil prices going lower. So we have a situation where not only were producers able to re-hedge, but because they made so much money on their original hedges, in some instances they could have hedged 30% more production. So we're looking at a situation where we're not going to see, everyone is talking about this pullback in production. It's not going to happen. It's certainly not going to happen in 2015, and it might be delayed as far as 2016. So we're looking at a situation where the United States will be producing 9.2, 9.3 million barrels a day of oil, which is the highest level since the early 1970s. And we're looking at a stagnant economic growth. So we continue to put oil on the market. And what's going to happen now, and it's going to happen sometime this year, is the capacity to store oil is going to be completely full. Back in April, the capacity in the United States was at 93% of working capacity, and then it was upwards of 72% of shell capacity. Shell capacity is the maximum amount you can put away. Now what's going to happen when you run out of places to store the oil, we can't export the oil, and we're going to be producing oil at 9.2, 9.3. That's going to put a lot of oil on the spot market. So we're looking at a potential period of very low, $40, $50, $60 oil relative to what we've seen over the past 5 years. So who stands to benefit from this? Well, with the MLPs, you have to stay away from the upstream guys, the E&P guys. These are the guys who, once we do get that production, they're the ones who are going to be hurt the most.
Who are the E&P guys?
E&P are
exploration and production.
Exploration and production. The guys actually looking for it and pulling the oil out of the ground,
and then selling it.
And so, and then you have essentially three markets. You have the upstream, you have the midstream, and you have the downstream. The upstream you have to stay away from. Now we were talking about the pipelines. Pipeline companies are midstream. These are the guys that are moving the hydrocarbons from one place to another place. Now we talked about the growth in cash distributions. You have to be very careful. Now you generally like pipeline companies because they're a toll taker. They just move it along, they collect their rent, and it's a very low risk, high reward payout. But we have to be careful with how we're going to grow the distributions in some of these companies, because if we do get the pullback in certain basins on production, well, that's fewer production means fewer barrels, fewer hydrocarbons to move, and you're not going to get the growth. So you do have to be able to pick your spots. So if you look at pipeline companies that have direct relationships with refineries, if you look at pipelines, Spectra, for instance, up in the Northeast, the city of Boston is out on an island right now because we have all of this gas sitting in Pennsylvania in the Marcellus and eastern Ohio and Utica, and natural gas prices in the mid-Atlantic are very cheap because we have access to this oil. Natural gas. Boston does not have access to this gas. So you're looking at a very hot day or a very cold day, when the utility has to go in and buy natural gas to burn the next day to run its generation. You're looking at a situation where here in Philadelphia, our utilities might be paying $5, $6 a decatherm, which is approximately $30 to $36 barrel oil equivalent. On that same day, Boston might be paying $30 a decatherm, which is $180 barrel oil equivalent. So there's a tremendous demand for infrastructure build out to get oil not only from Marcellus up to Boston, complete demand there, but now with the growth of LNG, it's the movement of oil out of Marcellus, which Pennsylvania now has become the natural gas hub of North America, to move it down to the export markets down in the Gulf Coast.
So when you're looking at the MLP world that's transporting energy, what specific areas are you focused on in that?
I'm focused on the guys who have the niche markets. So right now, these, and as I just said before, either you have a direct relationship
With the refinery,
with the refinery. Magellan runs the largest product pipelines. So I think there's opportunities there. But the real opportunity now is in the downstream. This is the final leg. This is the refinery. This is the guy who's buying $40, $50, $60 oil and then turning around and selling gasoline and diesel fuel at a $60, $70, $80 barrel oil equivalent.
Is that because he's buying it at U.S. prices and selling it at Brent?
Well, he's buying it in the individual basins. So,
Okay.
So here in Philadelphia, for instance, Philadelphia is the Houston of the East Coast, and
I like to hear that.
we had a significant problem 2 years ago where every refinery from Trainer to Marcus Hook to South Girard, every refinery on the Delaware River was going to close.
That's right.
And the problem it's that the refiner on the East Coast, their traditional source of oil was from West Africa. So whereas oil in the middle of the country, because you couldn't get it out of the middle of the country, was trading at a $30 barrel discount. So if you're a refinery in Philadelphia, you couldn't compete. So we had a major retrenchment in the industry where one refinery, the Marcus Hook refinery, did close, but we managed to save the other refineries. And what happened is we began to transport the oil via trains. You actually have trains that come into Albany, New York. It's kind of like the reverse Erie Canal. We have the train come into Albany, New York. They put it on a barge. They send it down the Hudson. They send it out to the Atlantic. They scoop around the Delaware. And now the Philadelphia refineries have access to very cheap oil.
Yeah.
Now, because the refinery is the only guy who buys crude oil. So you have a plethora of crude oil, you have a lot of competition, you have the price decline. Now with gasoline, with diesel fuel, your demand is much more inelastic. So you have not seen really a commensurate pullback in product prices. And so the refinery, the guy buying this very cheap oil, is still selling it at a very nice margin. And what's nice about that is the consumer really is still benefiting from it because we're still paying $1 a gallon below where we were a day ago. And that works well. Again, as I said before, not in general for the economy, but psychologically, that certainly helps.
How long do you think this refinery bonanza can last?
Well, right now you have a couple of instances going, and it can last. Right now we have short-term demand that has been moved forward. That is to say that, for instance, in January, I was able to, personally I wasn't, but theoretically, I could have purchased 2 million barrels of oil. I could have I could have chartered a VLCC, a very large crude oil carrier, put my 2 million barrels on that carrier, agreed to pay the shipping company $45,000 a day to store that oil. And I could do that for a year, and I was still able to make money. Because you had such a situation where oil was very cheap in the spot market, but as the curve went out, and this structure is called the contango.
Yeah.
It's the most bearish structure there is. People will look at the contango and watch prices go into the future thinking that is bullish. No,
Yeah.
it can't be any more bearish.
Yeah, we need to wrap up.
We have a
Summation.
And so right now, the refinery, we can stick around. Right now, we have artificial demand, but once that storage space gets maxed out, once that throughput gets maxed out, we're going to continue to see oil come to the market. You're going to continue to see, through the remainder of this year, very depressed oil prices.
Thank you.
All right.
Very good conversation. Clearly, we could keep going.
Yeah, absolutely.
We were just getting started.
That's right. So thank you for tuning in. Our guest next week will be Sky DeMoya, and she's with Penn by Air. She will talk about use of drones and video in the business marketplace. In the meantime, remember, your money matters.
Very good.